Morning, students. Students, we will now look into this particular second part B of the capital gains session, in which we will discuss the remaining part of the amendments which are there in the capital gains side. Students, before I proceed further, my sincere request to all of you would be this, that if it is possible for you students, because of the amendments I've seen, yesterday I told you one thing, that the very fact that the budget of 2024, because it has two budget, and the main budget was the budget after the election, the effective dates when the provision has to be implemented, that probably is different from various amendments. Like yesterday we have seen about the fact that the definition of short-term capital asset that is defined. Now we have seen the effective date of that amendment happens to be that 23rd of July 2024 becomes a cutoff, the date, the D date. So what you can do is just that, students, make a list of it. I may say that you might have an entry of around 8 or 9 items or 10 items at the most, which is worth remembering. And once that has been done, what you can do in your examination, whenever that amendment has been asked, what you all can do is that please make a mention in your answer that with effect from this date. And by the very mentioning of the date, that with effect from this date, it will definitely will have an impact in the mind of the examiner. So do take a note of that particular point, students, and therefore just deal in that particular proposition. Now, one of the most important amendment, or may I say probably a historical amendment in the head capital gains, as you all are aware, is the fact that the indexation benefit has been taken away. And that becomes one of the most critical aspect of the CG, because obviously if an asset happens to be a long-term capital asset, then in that situation the long-term capital gains will be computed without the benefit of indexation. That is how it would be. Yes, we know that earlier, before this amendment, there were certain assets. Before this amendment, there were certain assets on which no indexation benefit would be available at all. There were certain assets even before the amendment. Like for example, bonds and debentures, you all are aware that there is no indexation at all. Even if the asset happens to be a long-term capital asset, I'm talking about the pre-amendment position. At the same time, students, you also are aware of the fact that there is section 112A, where the capital gains, once it is computed under 112A, in that as well, no benefit of indexation is allowed. So there are a set of provision which already existed, on the basis of which no indexation benefit was allowed at all earlier as well. But now with this amendment, across all the levels, the benefit of indexation has been taken away. The benefit of indexation has been taken away. However, students, there is only one exception that has been put up over here. Only one exception. What is that exception? Also, we will see in this regard, in this particular context, but let's have a look. So, students, please take a note of the page number of your module, which we are going to discuss now. So far as the amendment is concerned, page number is 60. Page 60, students. You'll see. In page number 60, students, can you see this point number 3? Cost inflation index. Under section 48, for computation of long-term capital gains arising from the transfer which took place before 23rd July 2024, the cost of acquisition and cost of improvement will be increased by applying the CII. So, transfer taking place, please make a point, students. What is important is the transfer should have taken place before 23rd July 2024. So it is not about the purchase of a capital asset, but it is about the transfer of a capital asset which should have occurred before 23rd July 2024, that the indexation benefit as per the old provision would be available. As per the old provision. Because in the old provision also, there were certain exceptions where the indexation benefit was not available, even if the asset happens to be a long-term capital asset. So what happens if a transfer takes place on or after 23rd July 2024? What happens then? Obviously, as per the statement and as per the amendment, we all know now that the benefit of indexation is not available across all the class of the capital asset which has been transferred on or after 23rd July 2024. However, I told you there is still one exception to that principle. What is that? We'll see in this. Now students, over here, this may be like, might be, or may attempt, at least you all at least should know about it. Might be thereafter, after some point of time, this particular point will become irrelevant. In your page number 61, students, can you see this summary table that they have made? A summary table, students, that they have made. Please have a look in the summary table. The summary showing the indexation benefit available to different types of long-term capital asset which are transferred before 23rd July 2024. And what is that? Bonds or debentures? No indexation. Capital index bonds issued by the government? Yes, it is. Sovereign gold bond? Yes, it is. Depreciable asset, primarily, or the other particular point, students. Market linked debentures? No indexation. Equity shares in a company on which STT has been paid both at the time of acquisition as well as at time of transfer? No indexation. Why no indexation? Because I just told you that here the computation will take place under section 112A, and the fact that the computation the computation has to be undertaken under 112A, the benefit of indexation is not available. I hope that all of you are clear with this one. Unit of equity oriented fund or unit of business trust on which STT is paid at the time of transfer. Again, indexation benefit, is it available? Answer is no. Why? Because same reason, the computation is anyway undertaken under section 112A, and because the computation is undertaken under section 112A, therefore the question of giving the indexation benefit will not arise. I hope that all of you are clear with this one. Okay, so we are just discussing what was the position prior to the amendment. That is, when the transfer, if at all, has taken place before 23rd July 2024, then this is a position. So obviously, students, yesterday also I told you, and again I'm repeating this point with all of you, that please be very careful about the cutoff dates. Be very careful about the cutoff date, students. Because in your examination, when you read the question, check out when the transfer has taken place. On that basis, you will have to take a position. On that basis, students, you will have to take a position, students. I hope that all of you are clear with this one. Every one of you. Fine. So, just see this paragraph below the table. Consequent to the amendment made by the Finance Act 2024, in section 48, no indexation benefit is allowable on long-term capital gains arising on transfer of any capital asset taking place on or after 23rd July 2024. This is what I have already told to you. Now, this is what is the exception, students. Now, this is very important point, students. This last paragraph, students, please mark up important point. This last paragraph of page 61 and the first paragraph of page 62, students. last paragraph of page 61 and the first para of page 62 is very, very important. Now, first of all, the last paragraph of page 61 tells you one exception. In that one exception, even if a capital asset is transferred on or after 23rd July 2024, still the benefit of indexation will be available. Which is that particular case and to whom this benefit is still available? That is what we will see. Just have a look. Be careful. It is applicable to a resident individual or the HUF and no other transferor. A transferor what is the who is the transferor? He has to be a resident individual. Resident individual or resident HUF. What is the capital asset that he has transferred? Students, what is the capital asset that he has transferred? He has transferred land or building or both. When a land or building or both becomes a long-term capital asset as per the present provision that we have just seen, so it becomes a long-term capital asset if the period of holding of such land or building is for more than 24 months. So if a resident individual or HUF, if he happens to transfer a capital asset being land or building or both on or after, when he is transferring on or after 23rd July 2024, on or after 23rd July 2024, then students, he has two options, and whichever is more beneficial, that option will be taken by him. So which is that two option? Option number one, students, do the way you have done it as per the old provision. What you have done as per the old provision, you will take up the indexation benefit, compute the index cost of acquisition, index cost of improvement, and then arrive at your long-term capital gains. And on that long-term capital gains, the tax rate would be applicable at 20%. That is option number one. And the second option, students, is don't take up the benefit of indexation. So simply full value of consideration minus the cost of acquisition, cost of improvement. And whatever is the long-term capital gains that you have determined without providing the benefit of indexation, on that what students? Apply the new rate of long-term capital gains tax. What is the new rate? 12.5%. What is the new rate? 12.5%. So apply indexation and then charge the long-term capital gains at 20%. Or don't apply the indexation and charge the long-term capital gains computed at 12.5%. Whichever is more beneficial would be the final option. Whichever is more beneficial would be adopted by such transferor. Who is the transferor? The resident individual or a resident HUF. I hope that all of you are clear with this one. Every one of you. Can you just read the last paragraph, students, here? What I have just explained. Please read the last paragraph. Yes, Tulsi. Please read the last paragraph, students. Fine, students. Perfect. Now I'll ask you a question. Once you've read it, now let me ask you a question. So the question to all of you is that students, you have to do the computation of capital gains, and then thereafter you have to do the computation of tax liability. So my question to all of you is that when you do the computation of capital gains, will you have a will you apply both the option to see which is more beneficial? Like in the computation of capital gains, apply indexation and then get your LTCG. And a second alternative, don't apply the indexation and get the LTCG. And then in your computation of tax liability, whichever is the more beneficial option, you accordingly will calculate tax liability in that particular manner. So my question to all of you therefore is, in your computation of capital gains, there are two steps. One is computation of income, which means computation of capital gains, and second is the computation of tax liability. So whether in the computation of your capital gains, in that, will you be providing both this alternative, or you will work out the capital gains computation without indexation? What you are going to do in this context? Can you get any lead or any idea by reading this particular provision? What is the approach in your main solution? In your computation of capital gains, will you go with this both the alternatives given to you, or you will stick to only one particular solution? What you are going to do? Students, be careful. Please read the first line. First line is the key, students. First line is the key. What the first line says? A resident individual or HUF, while computing tax on long-term capital gain. So this alternative has to be applied. This alternative has to be applied. Where it has to be applied? At the time of computing the tax liability. Computing the tax liability, students. Primarily, this is what it is. So be careful while you do the computation of your income. Don't do the computation as per the two alternatives which has been given to you. Computation of income would be only as per one alternative. And what is that one alternative? Without indexation. Without indexation, which is the new law. But when you will calculate a tax liability, at that point of time, you will work out both the alternative and see whichever is beneficial, you will go with that. Whichever is beneficial, you will go with that. Students, the hint to my question was already given to you. Either you could have read the first line, that is very much explicit, or there is one more hint on the basis of which you could have answered my question. What is that hint? There is one more hint on the basis of which you could have answered my question, and that hint is this amendment that you are reading, or this exception that you are reading, is under section 112, and 112 is about the tax rates. 112 is about the tax rates on the long-term capital gains. Whereas the computation, students, the computation of capital gains in respect of non-depreciable asset, the computation of capital gains in respect of non-depreciable asset is undertaken under section 48. Are you getting this one now in this context? So therefore, a computation of a capital gains is under section 48. So the amendment which gives you two alternatives is not made under section 48. This amendment is made under section 112. And because this amendment has been made under section 112, therefore, students, therefore what? Therefore, while you work out your solution, students, your solution, please be very careful on this particular part. And what is that? You will have to ensure that you will not provide the benefit, you will not provide the benefit of indexation at the time of computation of capital gains. Work out without indexation. whatever is the LTCG. But when you will calculate a tax liability in that LTCG tax on this particular transfer, provide the two alternatives. And whichever is the more beneficial will be the answer. See the first paragraph of page 62. See the first paragraph of page 62. So I'm making you read all the amendments also, students, so that parallelly your amendments should also get over. So I'm making you read all those amendments as well. I hope that all of you are clear with this one now. Every one of you. So that exactly is the point, students. Any particular doubt, students, that you have, please let me know on this particular on the indexation side. So this is the only particular case which is left, students, where the indexation benefit will continue. But be careful, the presentation, if you do a incorrect presentation, students, and I'm telling you, your final answer may be right, but you will not get marks. So presentation is the key. I hope that all of you can appreciate this kind of subtle interpretation of law. Even the ICI module has captured this particular part in their notes. So they will be very severe in terms of how you present your answer. Any doubt, students, you have in this? Anyone? If not, then I can proceed to the next one. And the next amendment after the indexation, students, is the tax rates. So students, obviously, if the indexation is gone for long-term capital gains, if the indexation is gone, so the tax rate also will reduce. If the indexation is gone, students, the tax rate will also reduce. Do you all agree? So no indexation, the rate of tax also will reduce. In fact, if you are aware, students, I don't know whether you are aware of it or not. In the old, before the amendment, there used to be certain cases. I'm not discussing those cases, but there were certain cases where you have an option that was given to you. 20% with indexation or without indexation 10%. Remember the old particular position that used to take in the tax liability calculation? And what was the old position that used to take? 20% with indexation and 10% without indexation, whichever is beneficial. So the point therefore is now that is not no longer exist. Those positions no longer exist. So the only alternative which is available is this alternative, which is available to a resident individual or HUF who has transferred the land or building or both on or after 23rd July 2024. For them, this option is available. For all the other cases of long-term capital gains, the tax rate under section 112, the tax rate under section 112 is 12.5%. All the cases. Yes, all the cases, students. The tax rate is 12.5%. So only this case now is the only case left under the capital gains, where you have this particular alternative basis of computing the tax liability, and choose whichever is more beneficial option in this two. In all the other cases, I'm repeating, in all the other cases, what is the scenario? The LTCG under section 112 will be taxed at the rate of 12.5%. So that way, for all of you, it is simplified now. You don't have to worry much now about some cases it was 10%, some cases it was say 20%. All that is gone. Now I will do some important interpretation, students, also with all of you about some non-resident tax provisions, where in NR taxation you have read something. I'll do those things also with all of you quickly, but let me first finish it off, this particular part. Please come to page number 120 or 121. Students, in your module of ICI, the rate of tax. So the last amendment, students, I hope that you are taking note of the page numbers as well. The earlier one was, I think, page 61. This now it is in page number 121. Page number 121. No, 122, sorry. Students, 122. No, it is not also in 122. Where it is? Just a second, students. Sorry, it is in page number, students, 128. Students, page 128. Special, is there any special rate of tax on the short-term capital gains? Is there any special rate of tax on the short-term capital gains? To that the answer is yes. There is only one particular case of short-term capital gains where we have a special rate of tax. Only one case. Which is that one case? That is section 111A. So in section 111A, students, what you are going to find in this particular context, that if you have transferred an equity shares or an equity oriented mutual fund or a unit of a business trust in a recognized stock exchange on which the STT is paid, the old tax rate that you are aware, what is the old tax rate, students? 15%. 15%. Now this, students, please have a look. This rate also has increased. Page 128, students. This rate also has increased. So now any particular equity shares of a company, unit of equity oriented mutual fund and unit of business trust. Now students, obviously these are listed shares, and if they are listed shares, how they will become a short-term capital asset? So they will become a short-term capital asset if the period of holding is up to 12 months. If the period of holding is up to 12 months, so in that case it will become a short-term capital asset. If it is a short-term capital asset, it will result into a short-term capital gains. And if the transfer of such asset, has taken place on or after 23rd July 2024, on or after 23rd July 2024, then the rate of tax in this particular case, would be 20%. So that is another amendment, students, in this particular context, which has been there. So this STCG rate has been increased. Apart from that, all the other STCG, students, all the other STCG, is there any special rate of tax? Answer is no. So for all the remaining STCG other than 111A, what is the applicable rate of tax? The applicable rate of tax would be the one to which the person to whom the tax, for whom the tax liability is computed. So whatever is the tax applicable to that person, that is what we will apply. That is what we will apply, and that exactly is the point. So this is what it is, students, in this regard. I hope that all of you are clear with this one. Rest everything is the same, nothing changes. I'll request to all of you just to quickly go through this particular other part of the provision and in the module of this particular side. So the rate has changed from 15% to 20% for short-term capital gains under 111A. come to 112 now, students. This is where exactly we are, isn't it? So what they are doing, students, over here, they are giving you first category for transfer which has taken place before, for transfer which has taken place before 23rd July 2024. For transfer which has taken place before 23rd July 2024. And then thereafter, they are giving you the transfer which has taken place on or after 23rd July 2024. So what happens for a transfer which has taken place before 23rd July 2024 in this context? So over here, if you see unlisted security or shares of a closely held company, so unlisted shares. So in that case, students, what happens? Remember, if the SSC is a non-resident, be careful. These are the position that many students, if you find it difficult to remember this position, forget it. Primarily, you don't need to now remember this. Although chances are there that they can target primarily in this case for say a non-resident, like for example, remember indirect transfer, students, an indirect transfer question. Some question we already did in the class also, where a non-resident is transferring a shares of a foreign company. Which foreign company? That foreign company which is deriving its own value substantially from the Indian asset. Which is deriving its own value substantially from the Indian asset. In that case, the shares of such foreign company will be deemed to be situated in India. So therefore, in that case, students, if you see very carefully, if a non-resident is transferring what? Shares of a foreign company, which is deriving its own value substantially from the Indian asset. So what happens? This shares of a foreign company, students, it is an unlisted shares, because obviously this non-resident transferor who is transferring the shares of the foreign company, this non-resident transferor will have to calculate the capital gains. Now what he has transferred is the shares. Is the shares listed in India? Shares of that foreign company listed in India? No. So it is an unlisted shares. Now, for unlisted shares to become a long-term capital asset, what is the period of holding that it should have? It should have a period of holding which is more than 24 months. For an unlisted shares to become a long-term capital asset, the period of holding should be more than 24 months. So assuming the period of holding is for more than 24 months, this non-resident transferor has held the shares of the foreign company for more than 24 months. Therefore, the capital gains that he will calculate and consequently the tax liability that is going to calculate will be under 112, and 112 as per the old provision means transfer before 23rd July 2024. Transfer before 23rd July 2024 says that the long-term capital gains will be calculated without providing the benefit of indexation. And the applicable rate of tax would be 10%. So that is the position on or before 23rd July 2024. Now in the same question, now if I tell you no, he has transferred the shares say on 10th of November 2024. When he has transferred the shares 10th of November 2024. So obviously the old tax rate will not apply. And it is a long-term capital asset because the shares, the unlisted shares of that foreign company has been held by this non-resident transferor for more than 24 months. So what would be the rate of tax now? So no indexation. Any case before the amendment also no indexation, after the amendment also no indexation. In that particular case, students, can you see this? Straight away what? In this particular context, the second bracket. In this context, 12.5% without indexation, the second box. The first box, students, it is for land or building or both if acquired before 23rd July 2024 but has been transferred on or after 23rd July 2024. I already told you that two alternatives is there. With indexation, long-term capital gains will be charged at 20%. without indexation, long-term capital gains will be charged at 12.5%. Check whichever is beneficial would be a final rate. What about the second category? Second category is for everyone. Second category is for all the cases. What is all the cases? Land or building or both, if acquired on or after 23rd July 2024. Obviously, any land or building which has been recently acquired, for that this alternative is not available. This alternative is available only in the case when the land and building has been acquired before 23rd July 2024 and it is transferred on or after 23rd July 2024. Only then this alternative would be applicable. For a land and building which is acquired on or after 23rd July 2024, in that particular case, students, you would have to only go with the position after the amendment. And what is that? 12.5% charge on the long-term capital gains, which is computed without indexation. And the other, or see the last line, or the other asset other than 112A to be taken separately. So what about all the other asset? What will be the position, students? 12.5%. 12.5%. So see here, 12.5% without indexation. And after that, can you see in the bracket? In case of non-resident, long-term capital gains on transfer of unlisted security or shares of a closely held company would be taxable at 12.5% without indexation, foreign currency fluctuation. What does it mean, students? Simply put, you will not be doing any particular complications now. The position has become very simple. Very simple now, students. Whether you are a resident or whether you are a non-resident, only one thing you have to be very careful about is a land or building. So only for land and building, students, you have to be very careful. Check out if in the question involves land and building and it has been purchased before 23rd July 2024 and the transfer has taken place on or after 23rd July 2024. Then in the tax liability computation, not in the capital gains computation, in the tax liability computation, this is the two alternatives that you will go with it. And what is the two alternatives? Alternative number one, without indexation, 12.5% will be the charge on the long-term capital gains, and with indexation, long-term capital gains which is computed will be charged at 20%, whichever is beneficial. That is it. For all the remaining case of 112, whether you are a resident or non-resident, we don't care. Straight away, take the rate of 12.5% without the indexation benefit. I hope that this becomes very simple now. This position becomes, students, quite simple now, isn't it? And that exactly is the point in this context. So this is the amendment that you have to take into account. Okay, so no complications that in which case 10%, in which case 20%, which was there earlier, all that has been taken away. Simply put, only for land and building, just be very careful because of this alternative option which is available. Other than that, for all the remaining case, when the long-term capital gain is to be charged under 112, that would be charged at 12.5% without indexation, irrespective whether you are a resident or you are a non-resident. I hope that all of you are clear with this one. Every one of you. This is the position. In a very simplistic manner, I have told you, students. In a very simplistic manner, now I have told you everything. Now comes 112A. Again, there's an amendment in 112A. Students, 112A, can you see that? See the base rate. Land and building acquired before 23rd July and transferred after. Yes. Only for that only the alternative is available. Only for that only the alternative is available. For all the other cases, you don't have any alternative. The alternative is available only for a land and building which is acquired before 23rd July but is transferred, and it is transferred on or after 23rd July. So, students, with the long-term capital gains tax rate now at what rate, students? At 12.5%. Even the long-term capital gain tax rate under 112A, which earlier was at 10%, which earlier was at 10%, has also been increased to 12.5%. Has also been increased to 12.5%. Can you see that, students? Has also been increased to 12.5%, students. Can you see that in this context? Now, the stock market reacted a bit negatively in this context. So what they did was that they made one more change which was already there. Primary students, remember you did it for your attempt 1 lakh threshold limit. Remember you did for your this thing 1 lakh threshold limit up till November. So 10% was the rate of capital gains tax under 112A which was charged for LTCG in excess of rupees 1 lakh. In excess of rupees 1 lakh. Now, students, primary 112A tax rate is 12.5%. Whatever is the LTCG that you have computed, obviously no indexation, anything. Whatever is the LTCG that you have computed in excess of 1,25,000, in excess of 1,25,000, whatever is the remaining LTCG, whatever is the remaining LTCG on that 12.5%. So this is only to remember the numbers. There is no interpretation. On this, there is no interpretation. Just remember the percentage. Okay, earlier it was, what you did earlier was LTCG of 112A in excess of 1 lakh, the excess amount, whatever is the excess amount on that 10%. Now, LTCG under 112A in excess of 1,25,000, whatever is the excess amount on that 12.5%. Is that clear to all of you? Don't have to worry. Just that is, you need to know. You cannot afford to primarily go wrong and write the old provision in this case. That you cannot afford. So that is it, students, in this regard, in this particular context. But students, this is where all the amendments has happened of the capital gains primarily. What I will do, students, is that I would want to solve with you one question. I have made a very good question in non-resident taxation, wherein in NR taxation the problem occurs. Here it is okay, everything is fine, but in NR taxation, students, the problem occurs. I have got some very good couple of questions, students, which I just wanted to solve with all of you. So, students, what I will request all of you to do would be solve this. Now, whatever is the question, I told you yesterday also, and I'm repeating this point again. I'm repeating this particular point again, students, with all of you. Please solve whatever is the Q&A which is available now, so that at least the question and answer would be very not difficult. Everything is known to you. Only thing is that you just need to come up with the terms of these amendments that we have discussed. That is it, so that you don't make any silly mistakes. So why I am only asking you to do this is only for one reason. One reason is that you don't make a silly mistake, because please understand, students, it will be a big blunder on your part. The moment the examiner sees in your answer that you are still referring the old provision, like for example, instead of 12.5%, you are writing 20%, which is not for long land or building, which the exception, but for all the other cases, or you are applying indexation, or for 112A you are going with 10% rate and that excess of 1 lakh, these things will not be tolerated by the examiner, and this puts off him badly. If you don't know these kind of amendments, this will put him off badly. You may not know buyback amendment, but I have taught you. I hope that every one of you have understood the buyback amendment yesterday, but I'm just giving an example. You may not know typical amendments. Typical amendments, you may not be aware of it, or difficult amendments, you may not be aware of it. That is fine. You may make error on that, but you cannot afford to make error over here. These amendments which we have discussed, if you make enough error over here, students, I'm telling you, it is going to put off the examiner big time. And whatever the good deeds of your answers, of other answers, you may have given a very fantastic answers in all the remaining question, but do this kind of a blunder, that is it. It will put them off. So my humble suggestion is that you may not solve it, but at least go through each and every questions in the capital gains now. Once you are done with this, just allow me, students, 2 or 3 days time for having one special session on NR taxation, wherein I will solve with you certain questions in NR taxation. And in that NR taxation with all the amendments, which is the same amendments, there are no new amendments. But how you will then, because your discomfort is not in this topic now, your discomfort would be in NR taxation. So that is what I will try to deal with it. Now, students, the next amendment session that we are going to have would be on the assessment procedure, the block assessment. Very important one. I will just allow me, because tonight I am having Hindi session. So might be on Sunday I will keep the session for block assessment. Just allow me to make an announcement. If there is any spillover of the Hindi session, then might be on Monday I will do it. So just allow me a day's time to make the announcement, either on Sunday or Monday. Students, block assessment, one of other big amendment. The biggest amendment, in fact, which is there. No, Shifa, this what you're talking about is 1 lakh, na? Because this was 1,25,000 which you're talking about it in your query. This was made even that before the election there was one more budget, isn't it? In that before election that was there, 1,25,000 already was increased. So they increased 1,25,000 in that budget which was before election, and 10% was the rate, the existing rate. After the election, they did 12.5% with 1,25,000 which was already there. Okay, so that is how it was. So students, just till in the meantime, go through those Q&A of the capital gains. That is what I will request to all of you. Okay, and now primarily the next particular amendment that I'm going to see to you, either on Sunday or Monday as the case may be, on the block assessment. See you then, students. Take care. Bye bye.